Okay, let's get started. Hello everyone, welcome. My name's James. I am one of the directors here at Block Earner. Block Earner is Australia's largest crypto-backed lender, and we've recently integrated Crypto Tax Calculator to help all of our customers produce better tax reports and help keep their accountants happy about their tax affairs. But Block Earner has been around about 4.5 years now. We do buy, sell, and borrow all in one place, and we are building the backbone of crypto credit in Australia. So thank you so much for joining us today.
Of course, happy to be here.
Yeah, mate.
Do you want to do a bit of an intro?
Please.
G'day guys, my name's Matt. I'm one of the partnership managers at Crypto Tax Calculator. Company's been around for, I think, 7 years now. It's founded by two brothers, cool dudes, surfer dudes. They were doing a bunch of activity back in 2017, then actually encountered their own crypto tax nightmare. And at the time, there was no software, no solution out there. And then being technical, being devs, they just got their laptop up, started coding a little bit, and then next thing you know, they've got a platform that a lot of people actually need. And fast forward 6-7 years later, we've got just over, I think, 500,000 users on the platform.
Wow.
Partnered with great exchanges like yourself, and yeah, we really try to tackle on complex transactions, exchange transactions, automate the process so users aren't just scratching their head and pulling their hair out come tax time.
Right, let's go. It's one of the parts of crypto that I swear such a huge percentage of crypto investors got involved to begin with because they thought they didn't have to pay tax.
Yeah.
Right. Like everybody early, like depending on how long everyone's been around the space, but early 2017, 18, 19, everyone's like, oh mate, this is how you don't pay tax.
Yeah.
You push it on chain. Little did everyone know that one of the core ideals of crypto is everything's transparent, everything's traceable, you can see. So it was only a matter of time until that dream faded.
It's funny, I meet people at conferences, they're like, wait, you have to pay tax on crypto? I'm like, yeah, I mean, if you're in like US, Australia, one of these countries, they're going to be chasing you and they literally like just panic and walk away.
Yeah. And you guys recently entered the US, right?
Yeah, we've been in the US for a couple of years now. It's actually recently become our biggest market. I mean, you can see how many people there. The adoption rates, I think, as high as Australia. So yeah, big opportunities globally as well. Like we're in 180 countries now. So yeah, big opportunities everywhere.
Right, amazing. All right, let's get into the good stuff. So, Matt, do I have to pay tax on crypto? And why?
Okay. I can't explain why, but unfortunately the ATO wants your money. So the ATO treats crypto as a CGT asset, similar to shares, similar to property, right? And you can split it up into two segments. First one's capital gains. So anytime you sell a token for another token, if you sell an NFT, either for another NFT, if you convert back to fiat, all these swaps, that's all subject to capital gains. If you've got like a crypto card and you go out, buy a coffee, you tap the card away, use crypto, that's also taxable. And then you've got income. So think staking rewards, mining, airdrops, anything that's earned as opposed to acquired, that's normally income tax. So you've got those two different categories. And the way it works is whatever you've made from income and capital gains, you essentially add that to your salary or whatever income activity you have, and then you tax at the marginal tax rate that you have there.
Okay. Yeah. And marginal tax rate, that means the rate I'm paying on my salary, I also pay on my crypto gains, right?
Correct.
Okay.
So it's the last bracket. So you have it split into brackets. It's like the highest bracket.
Oh, so it just goes straight in at the top.
Unfortunately, yeah.
Wow. Okay. So, what if I am? So you mentioned staking, anything earned.
Yeah.
Is there a difference between like on-chain liquid staking versus staking on an exchange?
They're both considered the same in the sense that you get taxed as income tax at the market value when you receive the stake rewards. So as soon as the rewards enter your wallet, they look at the market value of that and they go, boom, we're going to tax you.
That was the income at that time. Right. Even if that asset goes down in value over time, you're taxed when it entered your wallet.
Correct. Correct, and that's where a lot of people get caught because it's worth a lot when they receive it. They might hold on to it, write it all the way down to zero, and you can sell it off and you can realise a capital loss, but you've still got that income tax you've got to pay off.
Interesting.
Yeah.
Yeah. Writing it to zero is something I'm familiar with.
Yeah, me too. Me too.
Okay, next question. Okay, I think we've sort of covered what counts as capital gains versus income.
Yep.
Is there anything you wanted to add? Like, core difference being if I sell some Bitcoin versus if I'm earning a yield on, say, staking my Ethereum.
Yeah,
right?
exactly.
Got it. So what if you've never cashed out any crypto? Do I still have to pay tax?
Yeah, good question. This is a bit of a myth. Lots of people I meet, they think, I've never taken anything from my exchange to put back into my bank account, so I owe zero tax. Unfortunately, anytime you do a swap, anytime you get staking rewards, airdrops, almost any activity you do except for buying and holding is taxable. So unfortunately, you do still have to pay tax.
So you still pay tax even if you've never sold the asset, because it's just like getting income.
If you've received income or like staking rewards, still taxable.
Okay.
But the only way you don't pay tax is, let's just say you bought BTC, you hold on to it, and you never sell.
Yeah.
You're not taxed.
And so if the value of my Bitcoin's going up or down or sideways,
Doesn't matter.
as long as I don't sell it, there's no tax for it.
Yeah.
Okay. And so with things like shares and property, you get a discount if you hold it for over a year, right?
Yeah.
Is that the same with crypto?
Yeah, exact same. So if you've, let's say, made $4,000 in Ethereum, but you've had that Ethereum for longer than a year, the ATO goes that 4,000 divided by 2, will only tax you on 2,000, which is pretty good.
That's pretty good.
Yeah,
50% off.
I'll take that.
That's a sale. Okay. I had one other question. Oh, yeah. So say just on the discount piece, because I'd say a lot of people will be eligible for that.
Yeah.
So what happens if, say I have many transactions over a year that add up to 10 Ethereum, just for easy numbers. So say I'm buying 1 ETH a month or something and I get 12 ETH.
Yeah.
And then in the first month of the next year, I sell 1 ETH. Am I selling the one that's discounted for CGT, or am I selling the one that I bought at the end? Because it's a fungible asset, right? How do you work that out?
Really good question. So this will depend on the inventory method you take. So in Australia, the most common one is first in, first out. And that's saying essentially your first buy of that Ethereum will get matched up with the first sell, which is good because if you've bought it 12 months later, you've got that CGT discount applied. But you've got other ones like last in, first out, highest in, first out. You can use those as well, but you do want to speak to your accountant because there might be some different rules around there. But first in, first out is normally the one that people in Australia use.
Okay. Yeah, that makes sense. But of course, we probably should have prefaced this as this is high-level thoughts, not advice.
No tax advice here.
And there's just nobody better qualified than your accountant, right?
Yes, exactly. Yeah, that's what they do.
Okay, so we did touch on this, but it's an important one, I think. Is my activity on an exchange the only thing I need to report, or is it also my on-chain degen activities?
Yeah, unfortunately, you've got to report everything there. So not just your exchange data, anything you've done on-chain in your MetaMask wallet, even if you've got a ledger, cold wallet that hasn't been touched for 5 years, still got to report that. And the reason why is, let's give an example. Let's just say you buy 1 Ethereum on Block Earner, for $4,000, you move it across to your MetaMask wallet, price goes up to, say, $5,000, great, we'll open it up, you decide to sell. If you only report your Block Earner data, we will have absolutely no idea what happened to that Ethereum once you transfer it off the platform, right? You could have sold at a loss, you could have made a lot of money, but we don't have the full picture. So at CTC, what we get you to do is import all your data from every exchange, every wallet that you've ever used. Because if you don't, you're going to have missing gaps in your transaction history, and that can lead to an incorrect tax result. So that's really the problem that we're trying to tackle on at CTC. It's like this data reconciliation problem, which is, hey, as an investor, give us the complete picture. Because if you don't, the ATO is going to come knocking and being like, hey, we can see all these interactions with wallets, but you haven't given us any of this information.
Is that something you're seeing increasing in frequency? Like, is the tax office saying, hey, look, we can see you moved money off exchange, give us that next hop? Or is the tax office now a bit more sophisticated and they can see the wallet that you've drawn to and then they will do the reconciliation themselves?
They will never do the reconciliation for you. They might plug it into, they have internal software.
CTC probably.
They probably use something like that. But they'll plug it in and they will see all these interactions. They might not come down and do your hard work for you and say you owe this much.
But they'll say there's something more activity that you haven't.
Yeah, like if you've done 100 transfers between block owner and the SpendMass wallet, you only report your block owner. They're going to be like, buddy, like we can see a bunch of funds here. You got to kind of report that, or at least like tell us why it's not yours, but it's kind of obvious it's yours if you can transfer it.
Yeah. Okay. Yeah, it's just funny. I remember so many conversations at early crypto meetups that were all around how to hide your tax.
Yeah.
Right. It was just such a topic that people were passionate about. Like it was, you can go to your own wallet, and then if you go to another wallet, then who knows where that money comes from.
Tornado Cash,
right?
Use Monero,
right? But it just feels like that's not nearly as real as it once was. Is that right?
No, not anymore. So I guess this leads on to another question that often comes up. It's like, what can the ATO actually see? So 3 main points on this. Well, firstly, you KYC on most exchanges, right? Assuming you're using a legitimate exchange. The ATO can access that data, and as of 1st of January next year, I believe all Aussie exchanges and stuff have to actually report to the ATO. So they'll have all that information. Secondly, like you said at the start, the blockchain is an immutable ledger by definition, right? So every transaction that happens is permanently recorded, and it stays recorded forever, right? It's publicly visible. That means if you've bought on Block Earner, moved things to a cold wallet, we can see that outgoing transaction. It's visible to literally everyone in the world who can access Etherscan or whatever it is, right? And then the third point is you've got companies like Chainalysis who literally spend all day tracking wallets. They're looking for tax evasion, fraud. They're the guys who took down like a lot of money from the Silk Road, that kind of stuff. But they're out there to investigate what's going on. So if you've got a bunch of money in crypto, you're trying to evade tax, you've got literally people who are hunting for you, if it's not the ATO.
Yeah, I think I reached a very similar realization a couple of years ago that the resources of the people building the products for transparency are so much greater than any individual's resources, right?
Yeah.
So like if you think you can just withdraw money to some wallet and then maybe send it to some casino and then pull it out, and you think you've outsmarted literally global governments and Chainalysis and companies like that, like I think generally you're dreaming. Right?
Yeah, absolutely. Like people are going to come knocking. If you've got a bunch of BTC on a wallet and you go, lost it in a boating accident, like they're not going to just hop that. They're going to come knocking on your door. They're going to look at like where your money's going. Have you bought a new house? Have you bought a new car?
Right.
They come knocking.
Right. That's quite interesting. So even in the like tiny chance that you are able to hide your crypto, once you start buying things in real life, then the question comes up.
Where'd you get that money from?
Yeah. So it's just far better to do the right thing from the outset.
Yeah.
Totally hear you. Okay. Are there ways, so now we've spoken a lot about like transparency and how it's impossible to hide, but are there ways where I can legally minimize my tax?
Yeah, absolutely. The word legally is very important there, just remember. But there's a couple ways. The first would be that 50% CGT discount we talked about. So it actually pays off to be a long-term investor, not just from the fact that assets gradually move up, but the fact that you reduce your tax rate by 50%, which is great. You can also allocate funds to like an SMSF because they get taxed. I think at 30%, but if you hold for over a year, it's only 15%, which is pretty sweet. 15% is good on your crypto. And then you've got other ways. So, for example, we've got a tax loss harvesting platform in our software. We show you all your tokens, all your NFTs that have been absolutely wrecked. unrealized gains, you can potentially sell that off, lock in the capital loss, and that way when you make money in later years, you can actually offset that gain with that loss. So for example, myself, got quite a few losses. I'm waiting for my coins to go up, and once that goes up, at least I can reduce my tax bill from previous years and all those losses.
And so that's a native feature in CTC, right?
Yeah.
Okay, so loss harvesting is, am I understanding this correctly? It's the practice of selling assets at a loss to offset assets at a gain.
Yeah.
You can't offset like your income, right? It's only capital. Okay. Okay. And how long forward, say I loss harvest today, how long does that loss last?
Carry on forward. I believe it's 5 years.
Okay.
I might need to double check, but I think it's either forever or 5 years.
Okay.
I hope it's forever because it might be a while until I see some gain in my portfolio.
But yeah, I guess the point is, if you've made a loss on some of these like really speculative bets that are just never going to come back to life, like say if you're in the meme coin space and 1 in 100 you actually make money on, it might be worthwhile asking your accountant about how can I sell these ones at a loss to offset the one that I got right.
Exactly.
That's interesting. Nice. Okay, cool. What about, say, in the unfortunate scenario, you only make losses through the year, right?
Unlucky people, right?
Unlucky, right? How does reporting that work? Do I still need to report to the ATO only losses?
Yeah, so a lot of people think that if you've got losses, they're like, don't bother doing your tax returns. But if you end up making gains in future years, you want to realise those losses from previous years, of course, to offset it. So, if you've got losses from 5 years ago and you go back 5 years, ATO, it'll be fine, but the ATO is going to be like, you should have done it at the time. So no matter gain, loss, you want to report that at the time to make things smooth.
And there's probably a high degree of scrutiny if you're like, 5 years ago, I lost some money to offset my gains today.
Yeah. Right. If you make $500,000 and you're like, I lost $500,000 back in 2016, then you're like, trust me, bro, that's my source. Yeah. So you want to do it at the time for sure.
Okay. No, that's good advice, but not actual advice. General thoughts. Yes. Okay. All right, I'm just checking our questions. Let's see, should we check the chat?
Yeah, see if any questions.
All right. Yes, we are recorded. Sorry, Johnny has had some issues with the feed. No worries. You can watch the recording, Johnny. We've got you covered, mate. All right, so just checking the question. All right, so airdrops are an interesting one.
Yeah.
Mainly because, from my perspective, not all airdrops are the same.
Yeah.
So, some airdrops require me to, say, play a game, right? Like, if, for example, there's a platform called Infinex.
Yeah.
Right? And if you're playing the game on there, you get airdropped. But right now, the airdrop has no value.
Yeah.
Right? So it's just like points. What are your thoughts there? Is there any sort of reporting obligation or what do you think?
This one's an interesting one. So you can kind of split it into two. You've got your standard airdrop, which is, maybe you're an auction user, you do a bunch of activity, the airdrop time, you get the tokens, and as soon as you get the tokens, you can see it's valued at $100, for example. You'll get taxed at the value of those tokens, so you'll get income tax on the $100. And then if you decide to sell those auction tokens later on, you'll either get a capital loss or gain based on whether it's gone up or down.
I see.
And then you've got this thing which you're talking about called initial allocation airdrops. And that's when you receive, tokens that are yet to have a market value.
That could be a big result.
Yeah. So I think the hyperliquid and like the ENS airdrops fall under that bracket. But that being said, I believe when you actually go to sell them, you'll incur capital. So it's not like a free ride. They'll never give you a free ride.
So if you're, what is the cost basis though when you go to sell it?
Yeah.
If there was no value when they were allocated,
yeah,
how would you determine a cost? Like, what is your gain?
Yeah, they are. Unfortunately, they take your cost base as zero.
As zero.
Yeah,
Wow.
so
So 100%.
100%.
Wow.
Yeah.
Look, I guess that is true.
Yeah.
Because you didn't pay.
Yeah, you didn't
so
pay.
your cost base. Yeah. But my time's worth something. I'm playing.
Oh yeah, you've put in effort. It's hard to play games. It's hard work.
Yeah, airdrops. I think. What is your view? Because we're only really starting to get some clarity on how to treat crypto tokens in tax. So as the ecosystem continues to evolve, because I can imagine today we've got all these versions of airdrops that weren't even ideas 5 years ago. So in the next couple of years, when we've got all these new styles of airdrops, how do you think the right way to approach tax is in those scenarios?
Yeah, it does depend case by case, but I think I do like the initial allocation airdrop, the way they treat it, even though they're taxing you on 100%. At least you don't encounter this situation where you get a big airdrop, you get that income tax bill, and then the token rights is zero. You've got a capital loss, but you still have to pay income tax. I've met a lot of people who owe like $200,000 in income tax, and because like those tokens have gone to zero, they literally don't have the money for it.
That's crazy.
Yeah, it puts them in such a bad position. They have to sell their house, sell their kids, sell their wives. Like it's not a good situation. But with the new or with initial allocation airdrops, at least if it goes down, you don't pay anything. Like if you're on an airdrop,
right? Because you can't be offsetting income with capital losses, right?
Yeah.
So if you're owing income tax, then you sell the token for zero. There's no offset.
Exactly.
I got it. Yeah, that creates a pretty nasty scenario.
Yeah.
So is that to me it sounds unique to like staking rewards, right? So it's generally like if you've got your Ethereum or Solana staked, and you're earning, so you're accruing income essentially, and then if the price goes down, that's when you can't do the offset. Whereas if you're earning points or some sort of airdrop by a game or whatever it is that you haven't staked an asset, that's more like the initial allocation.
Exactly.
Got it. Okay. Great. All right. So what about at Block Earner we have a very wide range of users, and increasingly we have companies using us who actually accept crypto as a payment.
Yeah.
So imagine there's companies out there that might say, hey, look, rather than buying Bitcoin with cash, they will accept Bitcoin from their customers in lieu of goods or services, and then they will borrow from us to pay all their bills.
Gotcha.
Right? So imagine it's like a treasury asset. They manage their cash flow through us.
Yeah.
So when their customers are paying using crypto, how does that work? How should they think about their tax there?
Yeah, so if you get payment in the form of crypto, whether you're a company or whether you're like an employee who work for a crypto company, maybe they pay you BTC, that will be considered income tax at the value that you receive.
Oh, at that time?
At that time.
Okay, okay. Right, so income at that time, if it goes up, capital gain when they sell it, but only when they sell it.
Yeah.
If it goes down, capital loss, but not offsetting the income because it was income.
Exactly. Which is
I'm all over this.
Yeah, you're the expert. Should be interviewing you.
Okay. What are your thoughts on lending?
Yeah.
So people here, and I'm sure people watching the what's it called, VOD, afterwards, will definitely be interacting with Block Earner because we're a lender.
Yeah.
So what are your thoughts? Let's try and split it up into a customer who is going on-chain themselves and borrowing, and a customer who might use Block Earner. So let's start with on-chain.
Yeah, we'll start with on-chain. So let's just say you do a bunch of DeFi, there's a liquidity pool, you decide to deposit your assets. If you lose custody of your assets, and in most cases you do, that triggers a capital gains tax event, because the ATO says you no longer have ownership of whatever you've just deposited, right? So it's technically a sell. And it's a bit iffy here, like people argue, no, like they're still my assets, they're just in another pool right now. But the ATO says if you deposit into a smart contract, that triggers a CPT event.
Okay, so how would, for on-chain, strictly on-chain, how would you define like a loss of control? Like, because when I read opinions on this, it seems to be about control. Right. So let's use, say, what's the platform? Aave, right? So let's say someone puts some ETH into Aave. What do you think? Have they lost control of that ETH?
I think if it's left your wallet and it's now sitting in a pool or wallet that you don't own, I would say you've lost control. And then the ATO says this is especially true if you receive a token in exchange. So I forgot what it's called, maybe staked ETH gives you that token in exchange. And it's just a token that represents your staked portion.
So they give you Aave ETH back.
Aave
wrapped ETH. Okay, so there's a view that if you're receiving a token that represents your token in that pool, then it may be considered a taxable event and you should talk to your accountant about that, right?
Exactly. They see it almost like a swap, like you've sold your ETH and you've bought your staked ETH. Even though that's not actually what happened, that's how they see it.
Right. So it resembles a swap because the deep understanding of that interaction isn't yet in legislation, right? Okay, no worries. And what about using a platform like BlockEarner? How would you see that?
So again, general advice, always best to chat with your accountant, but I know you mentioned when people put down their BTC as collateral, they still own that BTC, right? It's not like they're flogging it somewhere and it's lost. So I think in that case, it would make sense that there isn't any tax consequence because they still have custody. They haven't lost their BTC. They haven't transferred it to another wallet that they don't own. So in that case, I would probably say no tax consequences. But again, your accountant would probably be able to write some better.
Look, we've always felt a similar way that the tax professionals are definitely the best guys to talk to. And I know we keep going on about it. It's just the reality. These guys live in tax law, so definitely give them a call. It is just worth noting that this was a consideration because imagine if you used BlockEarner and you triggered a tax event the day you opened a loan, you are essentially eliminating a huge reason why you would use us in the first place. So with our lawyers who drafted the contract, it's very specifically a mortgage. So the customer grants BlockEarner a mortgage, and it's very similar to when you release value out of your home. So imagine when you own your home and you might open up a mortgage on your home to then, so you grant the bank a mortgage on your home to release some capital. Did you sell your house that day? Right now, the law says that you did, right? Because you're still the beneficial owner, you still live in it, whatever, right? So provided you can satisfy some of those things, and we've got a lot of indicative thoughts from different accountants out there who feel like it resembles that same transaction, they agree that it shouldn't trigger a tax event. But it's always worth noting it's a novel space and one that anybody who says they can say absolutely this is what it is probably lying.
To be fair,
right? So it's novel and just talk to the professional, I guess, is the takeaway.
Absolutely.
Okay, we've made some pretty huge progress. I think it's worthwhile just giving anybody in the audience a chance if you'd like to ask a question. There's a small delay on the feed, so we might have to wait 10 or 20 seconds. So we'll do that. And if you guys have anything, please just write a message in the chat and we'd be happy to answer. Well, Matt would be happy to answer. I'm happy to read the question out.
That's good enough. Big fan of the houses, by the way.
Yeah, aren't they good?
Who designed these?
They were designed by Oscar, our designer.
Nice.
And so it's a great segue whilst questions will come in. This is for our home loan product. So so we get a lot of demand for mortgage repayments as loans and also home deposits. And so think of if someone's been accumulating Bitcoin over the last couple of years, they've had a good run. And now when they go to the bank and ask for a mortgage, the bank will say, show us your assets.
Yeah.
And they go, yeah, here's my Bitcoin. Look how good it is. Give me the mortgage.
Yeah.
And the bank goes, no chance.
That's worthless.
Worthless,
Yeah.
right? So we think, obviously as a crypto brand, we think there's just a better way. So we've spent like the last 12 months ideating and building a home loan product. So it's a one-stop shop product where the customer parks their Bitcoin with Block Earner exactly how they would a personal loan.
Yeah.
And we plumb them directly to a mortgage writer. And together they walk away with the mortgage. So imagine if you are looking for $1 million home, you might have 300K of Bitcoin.
Yeah.
Rather than selling, you park that with Block Earner and you walk away with the mortgage and with your Bitcoin exposure still intact.
Beautiful.
Right? So we've got all sorts of modeling that shows, over any 4-year window, your Bitcoin goes up. So by doing that, you might actually end up offsetting part of your home costs.
Yeah.
Because as we understand, homes are going up in value, affordability is going down. It's a really interesting product. Oz CryptoCon, going to share a lot more about it. Should be fun.
Exciting. And if the value of your property goes down, do you have to put more BTC down as collateral?
So we take no value of, no interest in the property.
Yeah.
We're only on the Bitcoin.
Okay.
So, and the mortgage writer takes no interest in the Bitcoin. They're only on the house. Right? So it's segregated. So if your Bitcoin falls, your home's never at risk.
Yeah.
And if your house falls, your Bitcoin's never at risk.
That's good.
They're segregated loan facilities, and it's very specifically done because they're different assets and you don't want any sort of contagion.
Yeah.
Dons has asked us, can 2 portfolios be created on the one CTC account?
It depends if you're filing those 2 portfolios under the same entity. So if you have like multiple wallets or different exchanges, absolutely plug that onto CTC. But if you're saying, you've got your SMSF portfolio and then your personal portfolio, you need 2 separate CTC accounts for that.
Makes a lot of sense. You wouldn't want to commingle your business affairs and your personal. Makes a lot of sense. Maybe an evolution on that question is, when I make a CTC account, can I add multiple wallets? Like say if they're all done personally, could I, because they're not different structures, they're just different wallets, can I add multiple?
Yeah, absolutely. You can just go to the integrations page, literally just copy and paste all your different wallets. And we've got a feature where, let's say, use a MetaMask wallet. If you plug in your wallet address, we'll actually scan all the EVM chains that you've got activity, and we'll automatically import that. So it's not like you have to go, base chain, import, BSC, whatever. We'll do that all in one go.
Amazing. Yeah. Amazing. Thumbs up from Don. Okay. I think everyone's had enough time to ask a question. Not that tax isn't exciting. Let's wrap it up, hey? Mate, thanks so much.
No, thank you.
Thanks for
and remember, Block Earner users can get 30% if you go to the taxes page in app. Click sign up, will automatically import all your Block Earner transactions, literally within a click of a button, and you get 30% year off your first year on us.
30% is a massive discount, guys, so definitely have a look.
Too easy.
All right.
Thanks for having me.